Scarcity in itself is going to create volatility by definition, but the thing is, volatility also can be a catch-all phrase for things to mean bad things, but I would go so far as to say there's things that can be good volatility and things that are bad volatility. Earlier this morning, I saw Gary Gensler on CNBC commenting on the rules making around quarterly earnings being moved to semi-annual and whether that's going to be good or bad. And he said, well, it's bad for investors and bad for investor protection because it's going to create more volatility. And I think the point that sometimes people miss is volatility that is created by having symmetric information that is pricing the market very quickly is very good. That's actually good to have volatility where there's liquidity behind it. What's bad is volatility or lack thereof because there's no price discovery. When people say private credit is an amazing opportunity because there's no volatility, that should be frowned upon as something beyond it in itself being a virtue. So I think the other part of this journey that we're all on with Bitcoin treasury companies now versus 15 years later is the knowing embrace of volatility and the kind of good volatility that I think is ultimately what Bitcoin represents because of the efficient liquidity of the market structure, which is really signaling information alpha. And it's not driven by other kinds of manipulations that otherwise is not available in open source way that all of us can observe.